Hello everyone. For this video, I'll be going over week 6 quiz axis chapter 3, um, question number 6. So in this video, I'll be walking you through how to prepare several year-end adjusting journal entries for a company. Um, Adjusting journal entries are crucial because they ensure that a company's financial statements reflect the true financial position and performance of a business as of the end of the accounting period. These adjustments are made before financial statements are prepared and usually involve matching revenues with expenses in the correct period. Every adjusting entry will impact one income statement account and one balance sheet account. Okay, so getting started, let's begin with the account with depreciation. So depreciation is the process of allocating the cost of a long-term asset, like equipment over its useful life. So in this case, the company's wind turbine equipment has depreciated by $6,900 for the year. And since depreciation is an expense, we need to record it by debiting depreciation expense equipment um, and crediting accumulated depreciation equipment for $6,900. Remember that the accumulated depreciation is a contra asset, so that tracks the total appreciation taken on the equipment over time. And this entry is going to recognize the wear and tear of the equipment during the year and bring the book value of the asset, so the wind turbine, to its actual close to its actual value. Moving on to a journal entry about prepaid insurance. So at the end of the year, the prepaid insurance account shows a balance of $3,900. However, only $1,550 of that remains unexpired. So that means $2,300 worth of that insurance coverage has been used up during the year. So to get that $2,350, I just subtracted um, the $1,500 from the $3,900. So here we need to reduce the prepaid insurance asset account to reflect the portion that's now expired. And I recorded that amount as a insurance expense. So we're debiting that insurance expense for $2,350, and we are crediting prepaid insurance for $2,350. So, which, as I said, reduces the prepaid insurance asset account. And so now the balance of the prepaid insurance account accurately represents the value of future coverage, and the expired amount has properly matched with the current period's expenses. Okay, moving on to question number 3, which is going to be talking about unearned consulting revenue. So, which is money the company received before doing the work. So the company was paid $8,700 in advance for sustainability consulting services. By December 31st, one third of the work has been completed. That means the company has earned $2,900 in revenue so far. So the unearned revenue is a liability because the company still owes the client work. As the work gets completed, the liability is reduced and the revenue is recognized. So here I'm going to debit unearned revenue for $2,900 and credit service revenues for $2,900. And remember, again, I got the 2,900 from taking one third of the 870, $8,700 cash. And so this entry transfers the portion of revenue that's been earned from a liability to income. So it ensures the company's revenue is not understated. Moving on to question 4, we're going to be talking about accrued wages. So these are wages that have been earned by employees but not have been paid out yet as of December 31st. So in this case, $3,100 in wages is owed to the company's organic produce workers. We need to recognize this as an expense for the year and also show that this amount is a liability until it's paid. So we're going to debit the wages expense for $3,100, and we're going to credit the wages payable for $3,100. And this entry ensures that labor costs are recorded in the correct period following the matching principle in accounting that we just learned in, uh, I believe, chapter one. Okay, and moving on to the last part of this question, um, we're going to be learning about accrued interest revenue. So let's adjust for the interest revenue that has been earned but not yet received in cash. So the company has earned $590 in interest from its investments in socially responsible bonds. Even though the payment won't arrive until January 12th, the income belongs in this year because it was earned by December 31st. So we record this revenue and create a receivable. So interest receivable. So we're going to debit interest receivable and credit interest revenue. This ensures the company's revenue is fully captured for the year, even though the cash has not been collected. Um, thank you so much for watching, and please comment any questions that you might have. Thank you.